All right, let's jump right into this explainer. Today, we're breaking down a fascinating, incredibly bullish thesis from Nuvama Institutional Equities on Divi's Laboratories. We're going to see how one of the world's most prominent pharma manufacturers is essentially building a massive engine for future growth, fueled by billion-rupee investments and shifting global supply chains. Seriously, if you want to understand where the global pharma industry is heading next, you've got to understand exactly what Divi's is building right now.
Here's our quick roadmap for today. We'll hit the growth inflection point, unlock Kakinada's capacity, explore the custom synthesis boom, look at their leadership in peptides, zoom out to CDMO and China Plus One trends, and finally, dig into the financial bottom line.
So starting with Section 1, the growth inflection point.
Nuvama is maintaining a buy rating, and they've bumped their target price way up to 8,550 rupees. Now, a number like that doesn't just come out of nowhere. We really need to unpack why they're so confident. They're looking at a company trading at roughly 42 times its estimated earnings for fiscal year 2028, and they see a growth runway that absolutely justifies that premium.
Just look at this signal from the managing director himself. When Dr. Murli Divi explicitly states in his annual letter that major programs are hitting commercial manufacturing in 12 to 24 months, he's basically flashing a giant green light to the market. He's saying the R&D and pilot phases, yeah, those are wrapping up. Massive, full-scale commercial orders are right on the horizon. Moving on to Section 2, unlocking Kakinada's capacity.
To really grasp this impending growth, we've got to look under the hood. I mean, you can't take on massive new commercial contracts from global innovators if you literally don't have the floor space, right? Just thinking about the sheer scale of the Kakinada Unit 3 project is wild. 6 blocks are already operational, 2 more are being built. We are talking about a 15 to 17 billion rupee investment sprawling across hundreds of acres. But the magic here isn't just the size. It's how this facility changes the entire chessboard for Divi's. Think of it like a giant set of dominoes. Kakinada acts as this backward integration hub. Right now, it's churning out basic starting materials. By shifting that basic, foundational production out of their premium, highly regulated GMP units, they suddenly free up massive amounts of space for highly complex, super lucrative client projects.
So what does that domino effect actually look like in dollars, or rather, rupees? By just shifting those starting materials over to Kakinada, Nuvama estimates Divi's unlocks a staggering 30 billion rupees in revenue generation potential. Think about that for a second. That is nearly 30% of their entire projected 2026 revenue, effectively created just by brilliantly reorganizing where they manufacture their ingredients. It is just an incredibly efficient use of capital.
Which brings us to Section 3, the custom synthesis boom.
All that freed up capacity feeds directly into this huge custom synthesis or CS expansion. This is where Divi's acts as the outsourced manufacturing arm for the biggest pharma companies on Earth. Divi is aggressively pouring about 20.5 billion rupees into 3 dedicated projects, rolling out between 2027 and 2029. And let's be clear, these are not speculative. If you build it, they will come factories. These are custom-built facilities tied directly to specific long-term supply commitments.
Actually, check out the 3rd project on this table. It's literally being funded by a capacity reservation advance paid by the customer. When a massive pharma company is willing to basically prepay a manufacturer to build a 7 billion rupee factory just to guarantee they'll have manufacturing space down the line, wow, that tells you everything you need to know about Divi's reputation and just how tight the global supply chain really is.
Nuvama is predicting these 3 units will generate enough revenue to completely double the custom synthesis business. We're looking at a segment that went from 40% of their revenue a few years ago to 55% today, and is literally on track to hit a staggering 100 to 120 billion rupees by 2031. It's the absolute engine of their long-term growth.
All right, Section 4, advancing leadership in peptides.
Custom synthesis is huge, but it's not their only weapon. If you've been following the pharma industry lately, you know peptides are the absolute hottest commodity right now. They're driving that massive, headline-grabbing boom in weight loss and diabetes treatments. Well, Divi's just inaugurated a brand new peptide center of excellence. They've built several 3,000-liter reactors, instantly making them the largest Indian manufacturer of SPPS-based peptides. They aren't just dipping their toes in the water here. They are aggressively moving to dominate the space.
Positioning themselves here is a total masterstroke. They are basically building a giant catcher's mitt to capture a piece of a market that's projected to explode to $175 billion by 2031. Global innovators are facing a severe capacity bottleneck for peptide manufacturing right now.
By having these state-of-the-art facilities ready to go, Divi's is perfectly positioned to catch all that overflow.
Let's pull back the lens for Section 5, CDMO Trends and China Plus One.
To really get the powerful industry wins filling Divi's sales, we need to look at the broader CDMO landscape. The company's specific strategies are great, but they're being amplified by massive structural changes in the global economy. Global innovators are actively trying to avoid building their own insanely expensive factories. Instead, they're turning to trusted partners for specialized tech, like highly potent active pharmaceutical ingredients or HPAPIs. Because drug development costs are astronomical, Big Pharma has to protect their margins, and outsourcing to a hyper-efficient partner like Divi's is the easiest way to do that.
And then there's the China Plus One strategy. Listen, this isn't just a corporate buzzword anymore. It's a tectonic shift. Estimates suggest India stands to capture up to 30% of the outsourcing market share migrating away from China over the next few years. As geopolitical tensions keep rising, Western pharma giants are desperate to diversify their supply chains. Large, fully compliant, and highly capable Indian manufacturers are the natural, obvious beneficiaries of this shift.
Okay, finally, Section 6, the financial bottom line.
Let's ground all this macro optimism in the hard reality of the balance sheet. It's one thing to talk about cool factories, but how does it look in the numbers? Well, you can physically see this engine of tomorrow being built when you look at their gross block doubling over the last 5 years. The gross block is essentially the physical footprint of the company, their land, factories, and machinery. Jumping from $63 billion to $122 billion in such a short time, that proves they are aggressively laying the foundation for massive future output.
Now, an astute observer might be thinking, wait a minute, if things are so incredible, why have return ratios slightly moderated recently? And you know what? It's a completely fair question. When you look at their financials, return on capital employed has actually trended downwards over the last few years.
But the answer is actually pretty straightforward. They are currently spending billions to build the engine. The true financial returns will hit once these facilities go fully live. It's like building a massive net before the fish arrive. When you're pouring billions into huge construction projects like Kakinada and the new custom synthesis plants, your capital is tied up, but it's not generating revenue yet. So naturally, that suppresses your return metrics in the short term.
But look at this impending payoff. Earnings per share growth is expected to absolutely skyrocket by 55% in fiscal year 2027 as these new capacities come fully online. Once those customer-funded projects and the Kakinada backward integration are firing on all cylinders, Nuvama expects revenue and profits to jump dramatically. The heavy lifting is pretty much done. Now comes the execution.
So I'll leave you with this thought to ponder. As global outsourcing violently shifts and the demand for complex, next-generation medicine surges, is anyone on the planet better prepared for the future than Divi's? They've got the floor space, the advanced peptide tech, the deep big pharma relationships, and most importantly, they have the physical infrastructure coming online at exactly the perfect time. Thanks so much for joining me for this explainer. I really hope it gave you a clearer view into the mechanics of this absolute pharmaceutical powerhouse.